You're listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder.
Well, we have a special guest on. It's probably my favorite guest we've ever had on here. I got to say that legitimately because we had a huge cancellation of a CPA that I really wanted to be on, but it happened to be the same time I got surprised. Somebody walked into my office, and it is who?
It's Kyla Snyder.
Hi. So my oldest just popped into the office late on a Friday afternoon, and it happened to be great timing. So perfect, awesome day for Dad, because not only did we have a great day in business today, but we happen to have you popping by. And when you're my age and you got kids in college and all of a sudden they just show up out of nowhere, it makes it for a good day. So appreciate you coming on. And I love the fact that I conned you into jumping on the podcast.
You did. I was not prepared to be on here at all. As you can see, I would have dressed a little bit nicer.
You're good. You're good. So I know over the years you've asked me all kinds of questions. And now that you're in college, you're asking me a lot. So I get to ask a lot of questions to you now. So, So how's college life?
That's good. Yeah, it's going good.
Where are you at?
I attend West Texas A&M University. I am a biochem major. I just changed that, by the way, to biochem because I needed some more biology classes for my pre-med. So, yeah, I'm a biochem pre-med major.
That's good. And you're in I can't believe this, a sorority?
Yes, yeah. I am in Zeta Tau Alpha. So I just joined this year through Formal Rush. So it's been a lot of fun. We actually have Pink Week coming up next week. That's our big fundraiser for breast cancer awareness and education. So
that's awesome. That's really good.
Yeah.
So can you talk like a sorority girl yet? Can you have they taught you that? Do you go through a class to
no.
do?
No.
Get that thing
we
like
actually,
totally.
No. We actually have a lot of ag majors, so it's more of Texan accents than anything.
So you throw in a lot of totally y'all. Is that the difference? Is that what you're saying?
I guess.
A little bit?
I guess so. I guess you can say that.
That's good. So I know you had some questions going into college, so fire away. This is going to be kind of like a little reverse than what we normally do. I'm usually the one asking all the questions and going through it. So, but we thought this would be a little fun because I know being 18, which you're down here for what reason, by the way?
It's my birthday weekend, so.
Yeah. And so come home, see Dad, because you know I'm going to take you shopping is what that is.
Oh, yeah. I need some more clothes.
And so on top of that, you already demanded 4 big fat steaks tonight for me to cook on the grill.
You offered. I was not demanding. You offered, and I took you up on that.
Yeah.
I haven't had a home-cooked meal in a hot minute.
Yeah, so I'd love to do it. So I'm excited. So anyways, fire off. So what's some questions that you have being very young in investing that you might, want some information or people in your sphere of influence you might actually get some value from?
Yeah. So what is it that you do as a financial planner?
I help you think. That's it. At the core of what I do, just like a doctor or like a lawyer or CPA, right? All those guys, that we just give advice just to help you think through what's important to you, what you're trying to accomplish. And by doing that and widen your perspective a little bit, like 2 degrees, it gives you more information in a way to ingest it to the level that our clients are at, whether they're very, very sophisticated and they have multiple businesses, all the way to somebody like you just starting out. Everybody's kind of got to go through that school almost because investing is a complex issue. And so we help people think through their greatest opportunity and what they're facing because there's so much to learn. If you don't have a good planner around you, you can actually run into trouble where you try to learn things that are irrelevant to your situation and you try to take on too much, and information sometimes kills, and it can really destroy what you're trying to accomplish unless you actually take the proper amount of information that applies to what your situation is and implements it there. That's the first thing. That's probably what I love the most, is just help educating. The second side of it as a planner I do is keep you on track. There's so many bias in the world from educational bias, like I just said, right? Informational bias. But there's also your own, what we call behavioral economics, where people, whether they're wrong or right, they'll believe what they believe and they won't take an objective stance onto how they invest. And so they just kind of, there's some great studies. Gustavo said this one lately that, people will invest into things that their friends invest in just to be in the circle, whether they make money or not. And so it's one of those deals that I help you keep on track. I help you identify what your goals are. And then we align you to what's important to you as far as an investment product, but also the way that you're perceiving the way that you want to invest, right? So there's different industries you can invest in, different products you can invest into, and different goals that everybody have that are different. So that's, in a nutshell, that's kind of what I do as a financial planner. Good question, though.
Yeah. Okay. So I don't know. So what would be like a good investment strategy, especially for young people?
Man, that is such a tough question, right? So here's the diplomatic answer. One is I don't know, right? So you can't, and as a fiduciary, that's somebody that takes their interest over my own, I have to look at every situation, at every person independently and see what their risk tolerance is, see what their long-term goals are. So I can't come out there in a broad stroke and say, this is what's important to everybody. With that being said, we can talk into general terms here, okay? So a good investment strategy for most people being young is to understand the broad markets first. And once you understand the broad markets and what an index is, and investing in indices or investing into overall broad markets in the very cheapest, lowest cost way possible, typically is a okay or a good idea to get people started in investing. And that's one way to do it. And that's the stock market. But there's a lot of other ways to invest. There's the bond market. There's the real estate market, right? There's private markets. There's a lot of different ways to do it. And so there's not a silver bullet. But most people starting out, right, just open up a brokerage account and understand taxation. So there's a difference in starting out investing is to understand that there's different types of accounts that are treated different from taxation. And so you have things called qualified accounts, which you might have heard of. 401k, have you heard of 401k?
Yes, yeah. I've heard of a 401k.
Okay,
yeah.
Then you got a 401k is like a company plan that companies offer that's similar to an individual retirement account, which is an IRA, which you can do today. As long as you make self-employment income or income that has self-employment tied to it, you can invest into an IRA. And then there's things like a Roth IRA. And then there's 50 different other types of registrations and plans. So a lot of things that you need to do early on is evaluate what you want to do with the money. Is this a long-term investing for retirement? Then, and you're young and you're in a lower tax bracket of that 10 to 20% tax bracket, then it's probably going to be invest into a Roth IRA for retirement. It's a good way to start. If it's something that, hey, I might need money sometime in the next 3 to 5 years and you're 18 to 25 years old, I might want to buy a new house. I might want to buy a new car or do something like that, and I need to start investing to save, then brokerage accounts is an account that allows access to it at any time, but you do pay a little taxes on the gains that you achieve inside those accounts. And depending on how long you hold those gains, you might get a little bit better tax treatments from what we call ordinary income, which is what your normal tax bracket is, to what they call capital gains treatment if you hold a security more than 1 year, which is at a lower tax rate. And at your age and your income level at 18, if you hold some securities in that brokerage account and it's less than, I think it's in that 50 range, don't quote me on it, I have to look it up, the IRS changes it, but it's between $50,000 and $70,000, and you hold it for more than 1 year, that capital gains treatment is actually zero tax rate. So you can still get tax-free income on that as you early start your career. and you start earning a little bit of income. So I always look at it from that way. If it's long-term investing, Roth IRA is the holy grail of investments, I believe. I'm not saying it's right for everybody, but I believe that is. But if you're thinking you want to access that money, but you still want the tax benefits, but they're still like 1 to 5 year investments, look at just a regular brokerage account, hold it in there, and depending on your income level, you might still get tax-free treatment on it to a certain level, and then it's 10%, then it goes up to 15%, then it goes to 20%. But typically, that's a good way to start.
That's good. Yeah, so speaking of like saving up for like houses and stuff like that, so what would you like, how would you go about doing that?
Boy, that's a tough question. Right. So right now we're in one of the toughest economic times I think we've ever seen in our lifetime, in my lifetime, in your lifetime for sure. Right. Because 2008, yeah.
I was 4.
4. I had to do the math in my head. Right. So you're barely, still crawling at some point, but, or running around drooling all the time, one or the other. But, the saving for a house, let's talk about the traditional way first. Okay. So traditional investing is a good way to get you started for saving for a house. And I think it's a way to compound your investment savings. The thing is, I always say overestimate the cost of what a house ownership is. So a lot of people believe that they just need to come up with some money, buy a house, and everything's okay. But what you're doing is you're taking on the responsibility of the home ownership itself, which is different than a renter. So in a renter, if something breaks, then you just call the landlord and they go fix it. Well, when you own the home, you got to pay the property taxes, you got to pay the insurance, you got to pay the maintenance and the upkeep and all that stuff. So when you think about owning a home, it's a little more complex than just owning the home. Okay, so you got to remember you're taking on additional responsibilities when you own that property. Second is, and this is where, to your point, I think, is like, how do I get there? And so one is back into the numbers the easiest way. So let's just hypothetically, I know it's really difficult in this market, but it's a round number. Say I want to buy a $100,000 house. I get it. The average median income in Texas is like $300,000 or something like that, $275,000. So it's really high up there. But let's just do a round number of $100,000 for a second. So typically you would want to put down 20% of the value of that house. Okay. If you do that, then you get outside of a thing called PMI, and that is property insurance pretty much. And it's, in my perspective, or what I've seen, it's wasted money. And what it does is it insures, and we talk about this with Tom Kuchar. So go back to our previous episodes and really listen to the PMI conversation with us and Tom Kuchar, which he's a mortgage broker. Great podcast to listen to. But you can skip PMI if you have 20% equity when you buy the house. Most people don't have that. And so you can go into an FHA loan, or you can go into different types of loans through the government. And you really need to talk to a mortgage broker, and you can put down 3 to 5% inside of there to buy that house. So on a $100,000 house, instead of saving up for $20,000, you can save up $3,000 to $5,000 and buy a house there. Understand, the less equity you put down on the house means that the actual monthly payments are going to increase pretty dramatically. And then you're taking on a mortgage, and that mortgage, you got to think through that you're making a commitment for 10 years, 15 years, 20 years, 30 years. They're just now talking about, they might actually have it out, having a 40-year mortgage, which is insane because rates are so high. And so the last thing you need to consider is high interest rates that we're in right now. So typically over the last 15 to 20 years, we were being able to have mortgage rates be around 3 to 5%. Now we're looking at 8%. Which is a huge dramatic change. It's almost doubles the payments that you have inside of it. So the easiest way on a conventional deal is save around 5 to 20% on the value of the house. You're going to put that in, align yourself with a mortgage broker, get pre-approved, go find you a good house and then buy it, and know that you're committed into that house. The other thing a lot of people don't understand is, my headphones keep on sliding on me, is a lot of people don't understand is that when you buy a house, you're also making a commitment that eventually you want to sell that house, right? But what they don't understand is you have to pay all the fees associated with selling a house. Typically, that's 6% to a real estate agent. Some are 3, 4, 5, or 6, but the industry average is about 6. Then you got to pay closing costs is typically around 2% in Texas. So whenever you buy a house, the second you write that check and take ownership of that house, in order to get out of that house, you just lost 8%. That is a good rule of thumb. So in order for you to sell that house sometime in the future, that means that appreciation of that house has to appreciate by at least 8%, typically around 10, before you even break even. So this is a long-term investment that a lot of people do. And I love doing it young, right? Because it gives you a foundation there, but you really need to make sure that you're in a place where, college kids, like, and we'll talk about the second way in a second, but unless they want it as an investment, that you really need to consider, are you going to be there a long time? Are you going to be there for 3 to 5 to 10 years? Does that make sense? To actually be able to get enough equity back out of the property so you don't lose money when you sell and go get your final career.
So how long typically does it take to break even on a house, would you say? Which I guess it kind of depends, but like on
It depends on the
average.
market, right?
Yeah.
So each market's different, but the rule of thumb is 3% a year. Okay. So that residential real estate property may I can't say absolutes, right? May actually appreciate 3% a year on a national average. Some markets, you've seen them go 15, 20%. There's been, Austin, there's some hot markets out there that will appreciate very, very fast. But those hot markets typically that appreciate very fast also depreciate in value. And so you got to be really careful on make sure of it. But a good rule of thumb is 3 years. 3% per year inside of there. So you want to live somewhere at least 3 years just to break back even on it. Now, I will tell you, with the economic uncertainty that we're currently in right now, we might actually see depreciated housing values. And so you might buy into too hot of a market and, that market lose value 10 to 15, 20%, and you might have to be stuck in that house for 10 years. So there's no absolute when you're looking at home ownership. And everybody looks at it like, I want to own a home. But there's been a lot of trends over the last 10, 15 years where a lot of kids your age, when I say kids because you're my kid, right? But a lot of young adults have looked at, I want to travel more than ownership. And so they would rather live somewhere a little cheaper and being able to have the flexibility, especially with working remotely, as they can work and live in multiple places, a year in Florida, a year in Colorado, a year here. And they move around a lot more because they have remote work capabilities. It's kind of interesting. I don't know if I would like that lifestyle, but it's an interesting concept before you go into home ownership. There's another way that you can own a home. And this is not one I can advocate. So I want to say that I'm just talking to you because, one, you're my child, and two, we talked about this before. But the three is one that a lot of people are looking at is if you have the means and or the sophistication to be able to go in there and buy a duplex or a quadruplex, then, or if you have some friends and sorority sisters and things like that, where you can actually buy a multi-door, almost like a mini apartment complex or a or a quadplex or a dualplex or something like that, and you rent out the other side, it might make a portion or all of your mortgage payment, so you're pretty much living rent-free until you build back your equity that you spent getting into the property, and then you go and do it again, and then you find somebody to take over your half or your third if it's a triplex or a quadruplex, and you keep on filling that up, and it allows you to build equity into multiple properties. There's a lot of YouTube videos on real estate experts that are doing this today. I like it for a couple of reasons, and I don't like it for the main one, right? So the main one is you're taking on risk. And not everybody can handle the sophistication of being able to collect rent, getting with an attorney, setting up an entity, paying your taxes, right? So I'm not saying this is, and I'm not advocating it for it, but I'm just giving this a holistic way to think is allowing somebody else to rent out a portion of your house or a portion of a multi-door building, a residential quadruplex, might reduce the risk that you have in making your monthly payments, but you might take on additional risk in the simple form that you have more sophistication to make sure you understand how to collect rent right. Making sure what happens if somebody doesn't pay rent, you got to evict them. All these other things that come into consideration with it. But it's a really cool way to consider that. What's neat about that, though, is there's really cool tax advantages as soon as you flip the way that you think. So there is very limited tax codes for when you work for somebody else. That's the way our society is built on. So if you go to work for somebody else, you get a W-2 wage, you get that standard deduction, and you get some child credits and all that stuff, and it's pretty limited. But as soon as you become a business owner, there's 70,000, I think is what the number is right now, pages of tax code benefits you can take advantage of. And so whenever you buy a rent property, set it up in an entity, and you become a professional real estate business owner, then there's advantages like cost segregation. There's things that you can do from a strategy standpoint of writing off your expenses in a very legal way. And you need to go talk to a tax expert on this. I'm not one. I'm not trying to represent. I am one. I'm just saying there is some really cool, crafty ways that young people very early on starting a business does a lot of things for them. One, it helps them grow up, I think, holistically, no matter what it is. You figure out real quickly when you start a business, that all the responsibility of that business is on you. And so of paying your taxes, of paying your employees, of running a business, and everything inside of that is very, very important. So the second way, more difficult one I like a lot is just trying to rent out portions of it. Got another one there for me? Or am I wearing you out too much?
Well,
you see any value from that or no?
yeah, I do.
So what are you doing?
What am I doing?
I mean, I'm going to be like, in the old fogey home here in a couple of weeks. And so you're going to have to take care of me eventually.
Eventually, yeah. Not right now, though. Hopefully not.
I think you might take me out to the pasture and just end it quick, won't you?
So, sorry, I'm like looking at all these. So, this kind of circles back to the stock market, but how do you stay like updated on like the changes in the financial market and like regulations and stuff like that?
Oh, man, you're just like trying to hit home runs and hit me with the hard ones. Real. All right, so that's 2 point. Staying up with the stock market is just do research. And there is multi-levels. There's macro, which is the overall, and there's micro, right? Mm-hmm. And so what I would tell a lot of people to do early on is find somebody that you think's a really good investor that is like a professional. A lot of people look at Warren Buffett. A lot of people look at, and I'm not advocating what Warren Buffett does. I'm just saying find somebody that they like in that investment sphere that they're in, and try to follow them, right? Ask a lot of questions inside there. There's a great thing called Investopedia. It's almost like a encyclopedia for investing, and it's a free website you can go on and you can just check out and see how things work inside the markets. It's a really cool deal. But I think education comes first, and then getting with a seasoned professional, a financial planner, financial advisor, somebody that actually knows that does educational first planning is another way that stays on top of it. And learning the basics, right? So I think one of your other questions that you were asking earlier was like, what is a stock? Which I was really surprised you hadn't asked that one yet.
Oh, well, yes, it is on here. Yeah.
So stuff like research is really a complex thing. And so it's so complex. We have Dr. Starr, which is, he's got a PhD in economics. We have Marco, which he just passed his level 3 chartered financial analyst designation, which is the highest designation you can have in finance, to analyze the market, right? And then there's colleges, there's master classes on these things that you can look for. So information is pretty readily available. Be honest with you, I look at Twitter a lot too now.
Really?
Yeah. So I would say 70, which my team here gets annoyed with me, 70% of my feed on Twitter is other CFAs that are money managers around the world. And so I look at them and now they're talking at a very high level. They're talking at a extremely high level of very technical aspects of the market. So you might follow those guys, but until you really understand what they're talking about, I always say I even have to go look up what they're talking about every now and then. And anybody that tells you they understand it all is lying to you. There's such a complex market inside of there, and there's so different levels of it. So there's a lot of experts in the bond market. There's equity experts in the value market. There's experts in the growth market. There's all these different type of flavors of investors you want to be. So that gets me down to the next question I think you were going to ask, which was, what is a stock? And that's where kind of you need to start learning. That's the most important thing. And to really break it down to us, a stock is simple. It's a contract that you have with a company to own a piece of that company. So when a company is formed, whether private or public, and we'll talk about the difference here, it is just an agreement, piece of paper of a percentage share ownership that you own inside of a company. Now, when it's private markets, that's like our business is a private market, and we have shares, and me and Mom own those shares, right? And that is kind of pretty simple. And so we value the company off of how many shares we own divided by the equity, or it's price over earnings, but the earnings that a company that it generates, right? And so a stock itself is on a public market is the same thing. It's just they evaluate that price based upon how many shares are in the public market. So a misconception that I find a lot is they'll look at a company and they'll say, this company's stock price is $587. And they're like, wow, that stock is really, really good because it's got a high stock price, right? And then they look at some other company like, a big tech company, and I can't tell you tech names publicly I can say sectors, but I can't actually tell the names. So let's say it's a big, huge product that ships it to you every single day to your doorstep, right? Mm-hmm. And that stock price is only at 150 or 190. And you would, on the surface level, you would look at and say, hey, that stock at 550 is worth more. That company's worth more than the company that's only worth 120. That's naturally what you would think, right?
Yes.
It's actually not accurate, though. It's not accurate because that company that has $500 per share might only have 1 million shares offered. So you take $500 times 1 million, and it might be $500 million company, right? While you got another company over there that's only trading at $100 a share, but it might have 1 billion shares on the market, and it could be $1 trillion company. So the share price means very little. It's really how many shares are available times the share price equals what we call the market capitalization of that company, or the market value of that company. And that changes on a daily basis, and that's why you see things like this ticking. So this $160 for that company and $30 for that company. None of these companies tell you the value of that company. None of the prices on here. All they're doing is telling you on an instant what you can trade your share for at that specific moment in time. That's it. That's all it gives you. And so you got to look at investing on a different way, which takes me to another deal is what type of investing do you want to be and how you want to look at it. And so inside the stock market itself, there's typically there's a lot, but there's two general, very high level macro ranges of stocks. The first one is the value stocks, which means it's like an old stock that's been trading for 50 years typically, and it's out, it's public, it's got a stock price, but it's not growing as fast. So why would you invest into a company that's only growing 10% a year compared to a big tech company that's growing at 500% a year?
I guess you could say there's more risk in the, the technology one.
Yeah, the growth rate's a lot faster.
Yeah, the growth rate's faster.
Yeah, that's absolutely true, right? Mm-hmm. So there's risk. So that there's a risk component there, right? So what the other one that a lot of people will do is the company that grows really slow typically has this nice organic growth to them, but they're making a lot of money. Mm-hmm. And they've gone through that growth curve, and now they're at the top of that growth curve.
And they've kind of plateaued, but they're
still making so much money. So what they're going to do is say, hey, I'm going to reward our investors for buying my company and holding its stock, and I'm going to give it a quarter or $1 or 50 cents every year in a dividend. And so that's the value kind of play. It's typically lower risk, not all the ways, definitely not always. There's different times, and risk is relative to what you're looking at. But there's easiest way to understand is value plays or value stocks typically pay a dividend. That is one of the characteristics. Not always, but mostly, right? And so if you're looking at owning something that has a less risk or less volatility, and you want to make income, right? So it's kind of cool if you're making money while you sleep, right? So yes. If you had $100,000 and you're making 5% in a dividend, While you're asleep, every year you get paid $5,000. And then maybe that stock grows 3 or 4% a year. So next year that stock's worth $105,000. Just in appreciation, it grew 5% that year. But then you also got a dividend of $5,000 to live off of. And then you take that dividend and you buy more of that stock and you reinvest it. And then before you know it, it doubles and doubles and doubles and doubles and doubles over a 10, 20, 30, 40 year period. Welcome to Buffett. That is how Warren Buffett made the bulk of his money, was investing in conservative stocks that paid a dividend, took that dividend and invested it again into other companies or that same company to grow his net worth. Now the growth side is kind of the newer one, where it's like, I'm going to put, $1,000 or $100,000 or some arbitrary amount into something that could explode in value very quickly. And I turn $100,000 into $300,000 tomorrow or next year or 5 years. Just way huge growth, but I could also go down a whole lot. Mm-hmm. And you see this in the biotech sector, where if one of their drugs that they're trying to come out with gets approved by the FDA, that stock could, rally hundreds to thousands of % in 1 year. While on the other side of that is what happens if the FDA says that, it's not approved, and that stock could literally go to zero tomorrow. And so there's risk on it. And I'm not advocating biotech stocks or anything like that. I'm just saying, giving an example of there's risk with growth that is, less in most cases with other ones. That's the difference in stocks. So just think of it like this. I own a very, very small piece of a contract of a publicly traded company, and I actually have shares of ownership in that company. That's what I'm investing into. And I predict, or I have reasonable assumptions, that sometime in the future, I can trade somebody else, which is what those numbers are on the screen, right? A different value for those shares. And I hope they're worth more sometime in the future. And if I do it right, they should go up, but nobody can predict the future, honey. Not me, not anybody else. So all we do is try to evaluate undervalued companies on what we think they're going to grow to in the future. So their earnings grow, their sales grow, right? And that more that grows, then typically sometime in the future, the stock is rewarded by a higher stock price.
So, been seeing a lot about, like market crashing and stuff like that recently, right?
Oh, yeah.
Yeah. So what would you suggest about staying on top of that and not going down with the market?
Going down with the market's not a bad thing. So remember when I told you everybody's different, right when we got on there? So think of it like this. So to answer your question, is nobody wants to lose money. I'm not advocating to lose money. But if you're a long-term investor, going down with the market is actually a good thing if you're continually buying into that weakness. So if you bought 3 times and the first time you bought it was $10 and you bought 100 shares, that'd be $1,000, right? The second time you bought it, it would be only worth $7 and you bought 100 shares. Now you only spent $700, not $1,000. And the third time you bought it, you spent this same 100 shares, right? But it's only $500. Now your total share count is like 2,200 shares. But what the really cool thing is, if you bought it at the same dollar amount, but different amounts of shares, or you can flip it around however you want to look at it, or you take and buy the same amount of shares for different dollar values. What you're doing is your dollar cost average, the average amount of, and not share cost average is the other way to look at it, but dollar cost average is how many dollars it took you to buy the same amount of shares over an extended period of time. So as the stock price goes down, you're buying more shares at a cheaper value, and your overall average is, like, if it's 10, 7, and 5, you average that together, right, at the same amount of shares each time, you're going to come out with a better stock price of like $7.50 or something like that. And then when it goes back up, that's how you make more money. Does that make sense? Mm-hmm. And so don't be scared. And I think a lot of consumers are afraid to lose money in the short term. And they overestimate volatility in a 1-year average, and they underestimate the gains in a 5 to 10 year average. And so remember that behavioral economics part where I say I help you stay on pace? I help people try to look at it from a 3 to 5 year average. Doesn't mean now with me and my CFAs and our team, we're looking at it on a very micro level of what it's doing on a very short duration, quarter by quarter by quarter. Okay. But for what clients need to look at it, or what most consumers need to look at it, is a little longer time horizon, and make sure they're suitable for those ups and downs inside the market.
So, can you explain like various investment options, like what's the difference between like a Roth IRA and an IRA and like a 401, which I mean you kind of did, but like I guess more like specifics, and then like what are like debts and bonds and stuff like that. And
Stocks and bonds.
It says debt. Yeah.
Yeah.
Debt and bond.
The debts and bonds are a great conversation. Let's talk about a debt first. Debt can come into different forms. You have short-term debts and long-term debts. And so most of the short-term debts people are usually understand most is credit card debt. And I would say typically before I tell you to invest any money, make sure that you're paying off your credit card and you have no credit card balance, because it's almost impossible to consistently outpace the interest that you're accruing inside of a credit card inside of the market. So I don't care how good of an investor you are, the probability of you beating a 20, 22, 24% interest rate in a credit card every single year is almost mathematically impossible. So it's better for you to actually pay down credit card debt faster than trying to save. Now, my rule is to have credit cards if you're fiscally responsible with managing them. And then taking on typical any bills you can do, eating out, everything like that is put it on a credit card, as long as you're responsible enough that you know that you spent that money whenever you made that transaction, and you're paying it off in 28 days later, or whatever your credit card limit is before you incur interest. And so this is what we do every single day. We run up a tremendous amount of credit card debt every single month through all of our businesses and personally, and we pay them all off at the end of the month. That way we can get all the 2% backs, right? You can get all the flights and all the rewards and all the benefits, and you use it legally to take advantage of what our current society is. I actually do not believe you should be able to get that benefit, but that's on more of a political stance than anything. But while our current system is capitalism the way it is today, go ahead and get the benefit when it's there if you're fiscally responsible. That is short-term debts, okay? Long-term debts are things like mortgages. Does that make sense? And so mortgages where you're going to have to pay for it for 5, 10, 15, 20, 30 years. That's a long-term debt. So you're making a commitment with somebody to borrow that money, and that's what the debt is you're borrowing money for 20 years or 30 years in a mortgage, and they're letting you use that, and you guarantee them an interest rate back. Now, that interest rate can be floating and change every day, every week, every month, every year, right? Or typically in mortgages, it's fixed for like 30 years. So you're getting a 6% interest, or you have a 6% interest on your mortgage. Right now, it's like literally just hit 8, which is incredibly high.
Can't you also refinance mortgages as well if the interest rate goes down?
Absolutely. You can. Okay. Now you got to look at the cost, because everything has a cost associated with it. So you got to look at the closing cost to actually refinance that, and if it makes sense. Typically, my golden rule is it's more than 1.5%, depending on the value of the property and the value of the debt. It does make sense. What I am not an advocate of is paying off a mortgage earlier. If the mortgage is at a reasonable interest rate, okay, there is great evidence on this, is that you can take and save that money instead of paying it off early, and put what you would pay off early into a brokerage account or into a retirement account, and use that money sometime in the future to make a bulk payment down on it. So you can still pay it off early, but you're using the markets to actually make you a little bit of money if you do it right. It's not guaranteed, but it is a reasonable way. And that only is applied if the overall market and that interest rate is in a reasonable spot. So again, everything involves risk, right? So if you had a 4% or 5% mortgage rate, and historically the S&P's made about 11%, then that's a reasonable assumption that the spread between 5% and 11 is 6, that over a longer period of time that you can make enough money to actually build up and not make the extra payments on your mortgage early on. Another way you could do that too is paying it on a weekly basis or twice a week basis, and you accrue less interest by doing that. You can actually pay your house off earlier and not make any more payments off of it. Really neat strategy right there. Going back to the debt, right? Mm-hmm. So let's talk money. How do we make money in debts? So the easiest way is using a bond. And a bond is a contract between a city, a state, a country that you're going to, as the bond holder, right, is going to give them money and you're going to take interest on there. The difference between a stock and a bond, though, is all of this is predefined in a bond. Like the interest that you're going to make for 20 years or 5 years is predefined inside of there. Now, there's callable bonds and there's other technical aspects of it. But the overall sense that you need to come away with is that I'm going to I'm going to give money to whatever the federal government, the state, the municipality, or a corporation on their debts instead of their stock. So I don't own their company. They just owe me debt. The company itself or the city or state owes me money. They're going to pay me an interest rate. So what's neat about it is the order of defaults are different. So if a company or a city or state defaults on that debt, bonds typically will actually be guaranteed before stocks are, so that you're in a better position from a risk standpoint by owning a bond. But historically, stocks will outpace what bonds do in performance, though. Not all the time, but historically, that's true. So you're taking on more risk by being in a second position, but the bonds itself are a little bit safer in paying you back out. Does that make sense? Mm-hmm. So a good mix of stocks and bonds is the golden rule: 60% stocks, 40% bonds, has paid out and been a safer as far as risk over a long period of time. That's been tested heavily over the last 3 years. And that's just a whole nother conversation. But that's how bonds work typically. You're getting what they call a coupon, or you're getting a dividend, a payment on a set schedule for the duration of that bond. And then all your money comes back to you in one lump sum. So you put $100,000 on a bond. They pay you 5%. You're collecting $5,000 a year for 20 years. And then at the end of that, they give you your $100,000 back and you buy another bond.
Okay.
Pretty clear? About as clear as mud?
Yes, it's clear as mud. Yeah. Yeah, that's very accurate.
All right, you got one more.
All right. So what is cash flow in investing?
All right. This is probably, let's break it down two things, okay? The most important thing that you can ever figure out about investing. The SBA, the Small Business Administration, and one of the big banks did a huge study that 83% of small businesses will go under in the first 3 to 5 years based solely on cash flow analysis, cash flow. And so what that is a lot of small businesses don't understand that I have to do X in sales or revenue to pay my debts at Y. And that changes every single month. But they don't understand how that impacts them over a long period of time. So cash flow investing to me is how much cash can I get off of a stock or bond to be able to reinvest it back inside of there. But if you're looking at it from the private markets, cash flow investing is more cash flow analysis. Is when you're looking at a company, is this company, for the price that you're buying it for, how much cash flow is spitting off of that company every single year? So that company makes $100,000 a year in gross profit, and they spend $70,000 in operating the business, paying taxes, paying their employees, right? Paying shareholders, paying their debts and bonds. And at the end of the day, they have $30,000 left. That $30,000 you're entitled to as a shareholder. Now the board of directors of that company might decide to keep that money in the company and not pay it to you in the form of a dividend, but that is the actual jack. That is the money that is actually yours as a shareholder sometime in the future. So cash flow investing and cash flow analysis is one of the most important things as a young investor that you look at. And this is, how do you go find where cash flow is at inside of a company? You know where to go look for it?
No, I have no idea.
So every public company puts out what they call a 10K. Okay? Ryan, double check if I said that wrong. I think it's 10K or K10. No, it's 10K. All right. So every single company puts out a 10K. A 10K every quarter comes out, and it tells you how much they did in sales, what's all their expenses, right? What's all their debts, what's all of their employee compensation. All of that stuff is inside of there. And then they also get into historicals and the future estimates, all kinds of stuff that goes into these things. And then you find out how much cash is pouring out of this company. And then you take that and you look at what it did last year, what it did 3 years ago, what did it do 5 years ago. And then you can do a really cool analysis on it to say, what's it going to do next year? And then you can get into that cash flow investing and see how this company could grow sometime in the future. And you could say, if it's trading at X right now per share, that it, with all of this cash flow coming off of the company every year, it should be trading at Y sometime in the future if it stays on that same projection. And this is what everybody's trying to do. Every single person is trying to figure out what that cash flow of that company is doing every single day, and that's how our entire economy is ran, is through cash flow investing. Now, there's things that companies can't control, though. So what happens if interest rates go way up and the consumer stops spending? Then sales go down, right? What happens if they have to take on new debt? Debt matures, remember, and they get their debt back and they have to go buy new debt, and their cost of capital goes up from 4% to 8%, and that affects the cash flow. So this is why you always go look at a K1, and I would say any young person that ever wants to understand how to invest, you can start investing in very broad indices to get a little bit of the overall broad market. That's a good way to start. But if you really want to be good at it, you need to start learning how to, and I told you this when you went to college. I said, you can go get any medical degree you want. I'll support you all day long. But what did I tell you have to get before you leave college? You have to go take what class?
Finance class. Right?
There you go, right? Because everybody at one point in time, I believe, in life will always have to understand how to run a business. Whether you work for a business or you run a business, it does not matter. That's one of the things that I think in college you totally have to understand, or even in high school you start have to learning into, is a cash flow statement, right? An income statement and a balance sheet. And a balance sheet just tells you what your balance is, your assets that you have. Your income statement tells you what your income's coming off of it. And your cash flow tells you how is all that being worked through. So one can be and manipulate the other, and they can be hidden in different spots the way companies are. So you got to really understand how that is, and then you will really understand how things are categorized in there. So that's the biggest thing that I think everybody needs to understand. And that way, if you ever want to start your own medical practice, well, you now have basic understanding of what it takes for me to buy a building, right? Pay self-employment tax, run a business in its whole holistic plan, from start to finish, to make sure that you're not setting yourself up for failure, and that your failure in business is easy to be fixed. Because like the SBA just came out with that study, 83% of people that fail, they fail just solely based on they don't understand the cash flow of their own business. And it costs them too much money to run their business. And they are 1 day, 1 week, 1 month, or 1 year away from unwinding all of their value within their business, and they go broke. That's the thing that you got to be really careful on. So that's why I think everybody should have some basic, if you want, right? Like I said, I don't think anybody should be required to do it, but I am requiring you, if you want dad to pay for your college, to go take some type of finance class so you can understand it. Or you can come work for me here. That's work too.
Oh.
I keep telling the little ones that who's going to come over here and start working for me. And
One of them needs to.
I think it's going to be Adelie.
Think so?
Yeah, I do. I think it's going to be
Probably.
Adelie.
I can see that.
I could see that too, right? Because she likes to talk and interact
Yeah.
with people, and she
does.
likes math, and she's I think it's going to be that one. So I digress. Anyways, last question, and we're done. Last question, unless you have more.
The last question.
Oh, we can end there.
I mean, I thought you had stuff for me, but
that's it. But I'm getting tired, and my brain is starting to go. Yeah, it's Friday. I've had a long brain day, long brain week. So I appreciate you coming on, though, Kyla.
yeah.
I always love to get to see you. And being away from college, or being at college, it's getting easier. I would tell you it's not easy at all, and that's probably the hardest thing that as a parent to ever go through is that first time dropping a kid off at college and not seeing your car in the parking lot. I mean, in the garage at the house, and you know, it's a unique deal. So, but I'm glad you got to hang out with us on the podcast. And I appreciate you coming.
Yeah, of course, it's been fun.
Awesome. You're like, no, it's been fun. Yeah, definitely. Yeah, sure.
I'm tired.
I appreciate it. Thanks.